let me present you the title of our presentation. So we are going to discuss about the CISEF, a composite index of social, environmental, and financial performance, the importance of climate risks for investors, for institutional investors. So it's a presentation presented by myself, Noah Leroux, and Jules Vernet that is going to talk later. Now let me explain you the table of contents. So we are going to talk about the abstract and then the theoretical framework, also the methodological framework, and also the main findings, and I will talk about the limitation and how the paper is going through a sustainable socio-economic system.
The main question or issue addressed in the text are as follows. First, development of a composite indicator, CISEF. The text proposed the creation of a composite indicator of social, environmental, and financial performance called CISEF. The central question is how this indicator can be developed and used in the context of banks' valuation of legal persons. Two, integrate a vision of performance. The evaluation framework is a part of an integrated vision of performance, aligned with ISO standards and recommendations from academics and market practitioners. It explores how this integrated vision can be implemented and improved in the evaluation process. Holistic methodologic framework. The next highlight is a methodologic framework that aims to integrate a variety of perspectives into the evaluation process, reflecting the expectation of different stakeholders in banks' environments. Questions related to the implementation and effectiveness of this methodology framework are important. Managerial implication. We are we explore the managerial implication of bank adoption of this framework, particularly in terms of responsible lending, compliance with regulatory initiative related to the climate change, and potential competitive advantage for banks. Use of this framework as a screening in the monitoring tool. The proposed framework is presented as a potential tool for client screening prior to the loan decision and as a post-test monitoring tool. Questions arise about the feasibility and effectiveness of this application. This paper addresses the complex function of banks, highlighting their role as intermediary between depositor and borrowers. When a company is the borrower, the bank acts as a quasi-insider of the company, possessing inside information in the selection process. Banks have supervisory power of the governance of company independent of them. It highlights the importance of the bank valuation framework in influencing the portfolio risk-return ratio. The bank environmental involve various stakeholders such as depositor, shareholders, regulator, and the society at a large term. Agency conflicts between these parties complicated the definition of the bank's objective and the evaluation frameworks. How banks could respond to the differing expectation of stakeholders in the creation of the assessment framework. In recent years, there has been a shift toward more inclusive valuation framework, taking into account not only the financial creditworthiness of borrowers, but also their social environmental performance. This is driven by increasing regulatory pressure related to climate risk. Banks could incorporate corporate social responsibility (CSR) criteria into their assessments, signaling responsible conduct. The study takes a multidimensional approach to business valuation, integrated financial fundamentals, and corporate social responsibility criteria (CSR). The CSR, although difficulty to define objectively, is addressed using either standard and the Global Reporting Initiative (GRE), which consider economic, environmental, and social dimension. The adherence of large companies in the GRE principle and more than 100 financial institutions to the Equator principle reflect of a convergence toward more holistic assessments. However, despite the importance of CSR, the variety of reporting frameworks create confusion in their interpretation of organizational results, and the need to introduce composite indicators. In our multifaceted approach to business valuation, we combine financial fundamental with corporate social responsibility criteria. Our assessment framework, which comply with ISO standard, is divided in three dimensions: social, environmental, financial, reflecting our hierarchy of attributes. The social and environmental dimension, reinforcing the traditional economic vision, include information of labor practice, contribution to local development, use of natural resources, and waste management. The development of the CISEF is based on a rigorous calculation procedure that incorporate multiple dimensions and stakeholders' perspective. In this procedure, we use a quasi arithmetic mean as an aggregation function to synthesize the elementary criteria. Two, the different notation like composite indicator, I all companies, G all dimensions, social, environmental, financial, and all. Three, the normalization of the elementary indicator is carried out in accordance with the DGI procedure using a sigmoid function. 4. For stochastic evaluation, we adopt the multi-objective stochastic acceptability analysis (SMAA), considering a probability distribution FW over the space of possible weight vector. 5. Performance parameters such as a mean and standard deviation are calculated for each company evaluated. 6. An efficiency score is derived by merging delta and omega, representing a measure of benefit of the doubt unequally adjusted performance. 7. We introduce a holistic global score (SM) by aggregating spatial dominance information in the sigma mu design. The last one, overall score are normalized to the normal cumulative densities function. In conclusion, this procedure offers a robust assessment of the holistic performance of companies, taking into account social, environmental, and financial dimensions, while integrating the diverse perspectives of stakeholders. For additional analysis and potential managerial implication, we see that the holistic metric resulting from this evaluation process provides flexibility of use to the bank, allowing various applications to further the assessment or advise customer. Some examples, although not exhaustive, are presented below. 1. Business intelligence and scorecard. The composite indicator can be used as a scorecard, providing cardinal or ordinal information about estimating the value of a unit. However, in a complex reporting environment, attributing outstanding or poor performance can be tricky. A hierarchical decomposition using the multi-criteria hierarchy method could be applied to analyze and improve specific components. We are exploring the different methodological alternatives for evaluation and justify the relevance of the proposal framework. Flexibility of the methodological choice, the sigma mu method offers a remarkable flexibility by allowing the metric developer to choose a weighting aggregation function without initial bias. This approach, in line with the OECD recommendation on uncertainty analysis, give the composite index an intrinsic encapsulation of uncertainty in the final result. Let's watch a didactic application of the methodological framework. The author developed a concrete example of the use of the methodological framework to evaluate a set of firms, thus offering a practical demonstration of its relevance. We present variable, data, source, and parameter modeling with a focus of the composite social, environmental, and financial performance indicator. The latter is based on the major dimension, profitability, depth, and liquidity for financial, emission for environmental and social responsibility with product, community, human rights, and labors. The data comes from the Refinitiv database, showed for its extensive coverage of ESG sustainability indicator. The criteria selected reflect regulatory standard and disclosure. Let's see the empirical result of the CISEF performance assessment and its component for our sample of firms. CISEF's average time series for each sector highlight disparities in stability and growth between industry. Some sectors, such as basic material, energy, and telecommunication service, stand out for their higher volatility in terms of financial performance. The analysis reveals a bimodal trend in the financial performance of all industries, with most companies performing either well or poorly. Social and environmental performance show a wider variability. The performance of companies by country in 2017 highlight the predominance of Europe companies, particularly in the social and environmental dimension. A third bit model is then applied to break down the overall performance into its financial, environmental, and social components. Interaction are introduced to model custom effect. These results show how cost effectiveness has differentiated impact on CISEF depending on emission level, providing valuable insight for decision making. Taken together, this results in depth understanding of firm performance across various dimensions, highlighting the influence of sectorial and national variation in the assessment process. In conclusion, this didactic application highlights the flexibility of the frameworks, which is able to adapt the various data and sector. It emphasizes the importance of considering all the three dimensions in performance evaluation, thus providing an integrated approach for financial institutions.
Thank you, Jules, for these findings. And now let me present you our potential limitations. Our first main point was about the reliability of the paper. In the theoretical framework, the authors use different practices than similar studies. So in this paper, they use multi-criteria hierarchy and multi-viewpoints. And in every similar studies, they use single weighting vector and single decision maker. So there could be a different result and make the paper less reliable, and there is nothing to support their findings. Also, another point is about the precision of the paper. So in the theoretical framework, it's important to know that there are different criteria depending on banks. So every bank doesn't have the same standards and the same clients, so the criteria are different. And even if there is an example in the paper, it's not generalizable to other banks, and it could limit conclusions. Now let's go ahead with the problem of the data and its availability and quality. The composite index relies on the data, so if there is not enough data, there is a lack of precision, and if there is a lack of precision, there are biased results. and it make the paper less reliable and limit the precision of the paper. The point is about weight. So in the calculation of the composite index, the weights may be different considering different sample of people, because it's a subjective decision and there are varying perspectives. So it could lead to different results, and that could be biased, and the calculation could be not generalizable. Finally, these are the last potential limitation that we noted. First of all, the hypothesis. So there are qualitative and quantitative data. For the qualitative data, there is a risk of overlooking because of the bad hypothesis made. So there could be biased results and biased weight. So the calculation could be less reliable and it could limit precision. The last limitation is about sustainability. So as you know, sustainability is a changing word. We are increasingly turning to sustainability for the climate change, etc. So sustainability is in constant evolution with changing standards and changing perceptions. It limits the accuracy of the index with time and new criteria. So the final potential limitation is that the paper could limit its accuracy depending on the sustainability. So in the last part of this presentation, I will explain you in what respect the findings of the paper contribute to shape our understanding of the accurate strategy towards a sustainable socio-economic system. But first of all, let me remind you a definition about the sustainable finance from the European Commission. So sustainable finance is a process of taking environmental, social and governance consideration into account when making investment decisions in the financial sector. So in conclusion, this paper offers the CISEF index, so holistic assessment framework, a way to evaluate firms around the 3 points of performance: social performance, environmental performance, and financial performance. Now let me talk about the importance of the paper through a continuous improvement toward the sustainable socio-economic system, which create a gap between sustainable firms and non-sustainable firms, and it helps to push others to follow the path. About the policy, this paper helps the politician in their work through tangible goals. It also helps to promote sustainable practices and implement new standards and policies. Two other points that are important for a sustainable socio-economic system. The first one is about the climate crisis. So as you know, the world situation is getting worse and worse, and innovation to limit the climate crisis are really welcome to decrease the amount of CO2 in the atmosphere. But it's also a risk of greenwashing for every firm that use that kind of index. But also it's also important for the performance. So to change a firm's mind of performance includes social and environmental goals in everyday life firms' operations. Thank you all for your listening. We hope you enjoyed our video about the paper and that it helps you understand the paper more.